Tracy, I just wonder, Steve comments about the hawkish Fed, how the doves are becoming more hawkish, and yet we continue to chop around here. How long can that last, and is it earnings that need to come to the rescue?
So earnings season does start in a couple of weeks in earnest, and so far the forecasts have been pretty stable. Obviously, what we're going to be watching for in those earnings commentaries are things like, how much pricing power are companies maintaining? Are their margins holding up? And, one thing that we have noted when we look back in history is that the S&P does tend to be positive 12 months after the Federal Reserve starts raising interest rates. So that does give some support to continuing to hold equities and allocations here. But we are becoming more cautious.
So becoming more cautious means what? You're reducing your...
What that means is that we're becoming more cautious in both equities and fixed income. Within equities, we are becoming more quality oriented, and we're moving away from some of those higher beta asset classes like emerging markets and small caps towards those higher quality asset classes, especially in the United States, like large caps and mid caps. And within fixed income, staying toward the shorter to intermediate part of the curve and away from the longer part of the curve where, inflation rates and interest rates do have more impact.
Alicia, I'll put the same question to you, especially given the fact that the S&P has been largely range-bound. What is it going to take to see any kind of breakout, by the way, in either direction for stocks? And the argument that stocks are an inflation hedge, do you buy into that?
So, look, let's just start with the fact that more than half of the trading days this year in 2022 have been moves of 1% or higher. And of those, more than half of those have been to the downside. So it's been a very rocky start to the year. If you compare it to last year, only 25% of trading days were 1%. So it's a rocky start to the year. We expect the volatility to continue the rest of the year. The range is going to hold, we think, unless there's resolution kind of one way or the other. Difficult to call. I think that the 6 to 7% bounce that we got in the S&P was largely due to, selling out of bearish positions in January and February. And I think we really have to take to heart what we're hearing from the Fed this week, starting with Jay Powell on Monday, where he essentially said it's going to be 50 in May. And the question is, how does that reprice the curve if it happens, and does that open other meetings to 50 or even higher? And I think the market has not quite reflected that much yet. So we've taken the first blow. It was affected by Ukraine and Russia, but the stalemate that everybody's talking about means sanctions last longer and oil stays higher longer and food commodities prices stay higher longer. And all that's going to work its way into the inflation number.
Yeah. So what do you buy here? What do you steer clear of, Alicia?
Yeah, so look, we sold out of our consumer cyclicals several months ago. We're in a rate hiking cycle. We believe the Fed and what they're saying. And we like the CapEx cycle here, both on the hard asset and actually the tech side. So we'd be investing in CapEx. We do like energy here still simply because there is a supply shortage, which is not going away anytime soon. Even if there's a deal, energy will weaken a little bit, and then we think it moves higher. So we think that's okay. And we think industrials, materials here are fine. We like consumer discretionary, but only in services, not in goods. So we'd be very cautious on the good side, as most consumers last year really overbought on the goods, and the payback is here now. But services we think are still fine.